Welcome to the deep dive. Today, we're going inside the quarterly results of Jindal Steel for Q2 FY26.
That's right.
Our mission isn't just about reading out numbers. We want to really understand how a huge industrial company like this is handling, well, two completely opposite forces at the same time. First, they're pushing through this absolutely massive capacity expansion, huge project.
Unprecedented, almost.
And second, they're doing it while the global steel market is under, immense pressure from overseas and facing some softness here at home, too.
Yeah, it's a tricky balancing act.
We've pulled together everything from the recent earnings call, the press release, the investor presentation. We've synthesized it all.
Yeah.
What we really want to give you is the clearest picture possible of the costs, the challenges involved when you're trying to fundamentally change your company's output. We're kind of calling it the cost of change.
And it's a perfect quarter to see that contrast, isn't it, between the sheer ambition and the market reality. On one hand, the company hit these massive defining milestones, building new capacity, hitting the accelerator on their future plans.
Big steps forward.
But on the other hand, they had to swallow some very specific, quantifiable hits to their operations. And these hits were directly tied to that transformation.
Right.
So if you want to understand their strategy, you really have to see both sides.
Yeah.
The success and the, let's say, temporary operational sacrifices they made this quarter.
Okay, so let's kick off with leadership, because this quarter saw a really fundamental change right at the top. And that signals, I think, their intent for this newly scaled-up operation.
Absolutely.
We saw the introduction of the new CEO and key managerial personnel, Mr. Gautam Malhotra. That was effective right after the quarter, October 28th, 2025.
And this appointment, it's more than just, changing the person in charge. It feels like a strategic move to match the new scale.
How so?
Well, Malhotra's background is very specific. He's got 2 decades of experience, sure, across everything, operations, supply chain, sales, even M&A.
Covers all the bases.
But what really stands out is his academic side. An MBA with honors from Manchester Business School, plus specialized training from Indiana University in the U.S. and IIM Ahmedabad here.
So not just an industry veteran, someone trained for complex, modern, global operations.
Exactly. And crucially, look at what he's been focusing on since May 2024 when he first got involved.
Okay.
It's all future-focused stuff. Sales generation, go-to-market strategy, sorting out logistics, HR development, and maybe most importantly, technology and AI adoption.
Right. They're clearly signaling that this huge physical expansion needs to be paired with, cutting-edge business practices, optimization.
That leadership focus is absolutely essential because the physical expansion they pulled off in Q2, it was genuinely a giant step for the company.
Okay, let's talk scale. What are we looking at here?
The scale is almost dizzying, really. First, they commissioned the 4.6 million tons per annum MTPA Bhagwati Supadrika Blast Furnace 2, BF2.
4.6 MTPA. That's huge in itself.
It is. And just this one asset, BF2, it more than doubled the hot metal capacity at Angle. Took it from 4.25 MTPA right up to 8.85 MTPA.
Wow. So not just an upgrade. That's like building a whole new mid-sized steel plant inside their existing one.
Pretty much. We're talking massive new industrial infrastructure.
So doubling hot metal capacity in one shot, that's making a statement.
Absolutely. And that wasn't all. They paired it with the new 3 MTPA Basic Oxygen Furnace 2, the BOF2.
Okay.
Combined those 2 new assets, BF2 and BOF2, and boom. The company immediately lifted its total steelmaking capacity from 9.6 MTPA up to 12.6 MTPA.
So a 3 MTPA jump overall in steelmaking capacity just like that?
Just like that. They didn't inch forward, they took a massive leap. And what this means is they're now firmly on track to hit their stated goal.
Which was?
12 MTPA just at the Angle site and 15.6 MTPA overall steelmaking capacity of the whole company by the end of this financial year, FY26. They're on schedule.
Okay, so internally, the company's hitting the accelerator hard, investing billions, leaping ahead. But the big question is, what kind of environment are they expanding into?
Right. What's the external picture?
Because this huge internal push happened against a macro backdrop that was, well, less than ideal, especially for steel prices.
Yeah, that's right.
Now, the basic demand picture looks okay, maybe. The IMF nudged up its global growth forecast a tiny bit to 3.2% for calendar year 25.
Right, small uptick.
And India is still the fastest growing major economy. The RBI is forecasting real GDP growth here at 6.8%. So demand isn't collapsing.
No, not collapsing. But there's one huge factor weighing everything down, particularly in steel.
Let me guess. China.
Bingo. China. It remains the dominant and, frankly, destabilizing force in the global steel market.
How so this quarter?
Well, their steel output is still way ahead of their own sort of subdued domestic demand. And the result, a massive flood of exports.
We've seen this before.
We have, but the scale. China's steel exports surged 9% year-to-date through September 2025. They're on track for an all-time annual high of 117 million tons.
117 million tons. Just wrap your head around that number. The price pressure that creates globally must be immense.
It is. This huge wave of low-priced Chinese steel is the main reason global prices are suppressed right now.
And other countries are reacting.
Yeah, absolutely. You're seeing countries across Asia, Europe, putting up tariffs, non-tariff barriers, just trying to protect their own domestic industries.
Yeah.
When steel is flooding the market cheap, profitability just vanishes everywhere else.
And India wasn't immune to this flood, right?
Not at all. India was actually a net importer of steel for the 6th consecutive quarter in Q2 FY26.
6th quarter in a row. Wow.
Yeah. Imports jumped significantly, 36% quarter-on-quarter to 2.5 million tons. And even with safeguard duties supposedly in place, imports specifically from China still jumped 46% compared to the previous quarter.
46% from China, even with duties. That's concerning.
It shows the pressure. And you saw the direct impact on domestic prices here in India.
Right. Prices corrected downwards.
They did. Partly seasonal weakness, the prolonged monsoon hitting construction demand hard.
Always does.
And partly the softening Chinese export prices bleeding through. We noticed, interestingly, that TMT prices fell more sharply compared to HRC.
Okay, TMT versus HRC. Why the difference?
Well, it's a fairly common seasonal thing. TMT bars, thermomechanically treated, they're mostly used in construction.
Which slows right down in the monsoon.
Exactly. Whereas HRC hot-rolled coils, they go more into manufacturing, cars, appliances, some infrastructure too. That demand is generally a bit more resilient to the weather.
Okay. That makes sense. Useful context. The company management, though, they sound optimistic.
They do. They're banking on prices stabilizing, maybe improving a bit now that the festive season is over and construction demand should theoretically pick up again.
We'll see if that pans out.
So let's connect the dots. How did all this, the big internal changes, the monsoon, the low prices actually hit the numbers, the operational and financial performance for Q2 FY26?
Right. So production was 2.00 million tons. That was down 5% from Q1. And sales volume was 1.87 million tons, down 2%.
Okay. So output slowed down just before they commissioned the massive new capacity. Why?
Well, it seems like a classic case of short-term pain for long-term gain, as they say.
How so?
The operational dip was mainly down to two things. Yes, the prolonged monsoon we just talked about, but much more significantly, it was due to necessary planned plant shutdowns.
Planned shutdowns. To do what?
To prepare the whole Angle complex for integrating and ramping up that massive new blast furnace 2. For instance, they took the DRI plant, direct reduced iron, offline at Angle for about a month.
Okay, that makes sense. You can't just bolt on something that doubles your capacity without pausing things, making sure all the connections, the systems are ready to handle it.
Exactly. You deliberately take some downtime to make sure the integration works smoothly. But okay, hitting the pause button like that must have had a financial cost, right?
Oh, definitely. The financial hit was substantial. Yeah. But, and this is key, they've been very clear it was a one-off, a transition expense.
Okay, what were the numbers?
Consolidated gross revenue fell 6% quarter-on-quarter, down to INR 13,505 crores. And as a result of that, and the costs, adjusted EBITDA came in at INR 1,875 crores. That's a drop of 37% sequentially.
37% drop in EBITDA. That's steep.
It is. But they actually quantified the direct cost of the shutdown itself. That non-recurring cost was INR 174 crores.
Okay.
And then if you factor in the overall impact, including having to buy some external metallic inputs while their own plants were down, the total hit was approximately INR 250 crores.
Right. So the 250 crores, that's basically the price tag for successfully commissioning BF2 and BOF2 for doubling their hot metal capacity.
Yeah.
Puts the temporary decline into perspective.
It absolutely does. It's the cost of growth, the cost of transformation.
And what's interesting, especially when you talk about growth and spending, is how they managed their debt.
Yeah, that really stands out. They're doing this multi-billion-dollar expansion, spending huge amounts, yet their consolidated net debt actually decreased slightly compared to the previous quarter. It ended at INR 14,156 crores.
Decreased, while spending on massive capex. How?
Strong internal accruals, presumably,
Right.
even with the lower EBITDA. But the critical number is their leverage ratio. Net debt to EBITDA stood at 1.48x.
Just under their target.
Exactly. It really underscores their commitment to keeping that ratio capped at 1.5x. They're showing incredible balance sheet discipline even while undertaking this furious spending on future assets.
That fiscal control is pretty remarkable given the scale of the investment. They did give some forward guidance, though, didn't they, on costs?
Yes, a slight heads up. They expect toll consumption costs to increase sequentially by about $3 to $5 per ton in Q3 FY26. So a bit of near-term cost pressure coming.
Okay, something to watch in the next quarter's results.
So given they couldn't control China's exports, or the rain for that matter, how do they defend themselves strategically against that market weakness?
This is where their focus on value-added products, VAS, really seems to have made a difference in Q2.
Right. Tell us about that.
Well, it looks like a testament to optimizing their product mix in a tough market. Value-added sales actually reached an all-time high for them. 73% of their total sales in Q2 came from VAS.
73%, that's very high.
It is, and focusing on these higher margin, more specialized products definitely helped minimize the drop in their overall net sales realization, their NSR, even though commodity steel prices were soft.
Okay, so leaning into higher value products protected the average selling price to some extent.
Exactly. But the more maybe probing question is whether this was just a tactical defense or part of a bigger strategic shift.
What do you mean?
Well, they're also clearly executing a pivot in their overall product mix. The share of flat products in their total sales volume went up to 49% this quarter. That's up from 44% in Q1.
Shifting more towards flats, away from longs.
Seems like it. And management expects this flat product share to increase even more, maybe hitting 55%, even 60% in the second half of the year.
And why is that?
It's driven by the ramp-up of the new capacity at Angle. That new, highly efficient setup is geared more towards flats.
Okay, that makes strategic sense. Aligning the product mix with where the new optimized capacity is most effective. And presumably, flats might be a bit less exposed to the extreme volatility we see in, say, the long products market sometimes.
That could be part of the thinking.
Right. And this focus on optimization, efficiency, it leads us straight back to the new CEO's mandate on technology, doesn't it?
Oh, so.
Well, managing a massive 15.6 MTPA enterprise. You just can't do that effectively with old-school methods, spreadsheets, and clipboards. The investment they're making in Industry 4.0 and AI, it feels like a necessity for control and efficiency at this new scale.
And we're seeing actual applications being rolled out, not just talk.
Seems so. They talked about deploying IoT sensors for predictive maintenance, anticipating equipment failures, using computer vision systems, cameras, basically, for important things like safety compliance, checking PPE, and also for automated logistics, like counting billets accurately.
Okay. And AI specifically.
Yeah, building predictive AI models, trying to optimize really energy-hungry processes like the blast furnace operations, and also forecasting power demand more accurately to save costs.
Sounds impressive. Did they put a number on the savings yet?
That's the interesting part. The management was quite transparent. They said it's currently too early in the journey to put a hard dollar value on cost savings from AI.
Okay. So foundational work still.
Exactly.
Yeah.
It suggests the focus right now is on getting the systems in place, improving safety, boosting core productivity. You have to believe this commitment to AI is absolutely critical. It's probably the only way they can manage the sheer complexity and achieve the optimization needed to make these huge new physical assets truly profitable in the long run.
So they've hit the big 12.6 MTPA mark with BF2 and BOF2, but the ultimate goal is 15.6 MTPA. To get there, they still have several other major projects underway concurrently, right?
That's right. The heavy lifting on the core steelmaking capacity is done for now, but the supporting infrastructure is still being finished up.
What are the key pieces still to come online?
Well, a really critical one is the slurry pipeline. That's essential for transporting raw materials cost-effectively over distance. That's apparently 90% completed now.
And when does that get commissioned?
Expected sometime in the second half of this financial year, H2 FY26.
Okay. And what about raw material security? Backward integration is key for this kind of scale, isn't it?
Absolutely critical. You need to feed those massive new furnaces. So the you would call B1 mining activities, securing their own iron ore, that's expected to start also in H2 FY26, probably towards the end of Q4.
So captive raw materials coming online soon.
Should be. And then the final piece of the steelmaking puzzle itself, The remaining capacity needed to hit 15.6 MTPA, including another 3 MTPA steel melting shop that's also slated for commissioning in Q4 FY26.
So all the major components to reach the full 15.6 MTPA target should be in place by the end of this fiscal year.
That's the plan. Looks like they're on track.
Now, the financial commitment to make all this happen is just huge. What's the total investment look like so far, and what's the ultimate payoff they're aiming for?
Okay, the numbers are big. Total capex spent up to September 30th, 2025 was INR 30,849 crores.
30,000 crores already spent?
Yeah, out of a total announced capex budget for this phase of INR 47,043 crores. So they are deep into the execution phase now.
Almost two-thirds of the way through the spend.
Roughly, yeah. But the most critical number, I think, for anyone following this story, for you listening, is the return they expect on this massive investment. The promised return on capital employed, or ROCE.
What's the target ROCE for these new projects?
They're aiming for an impressive pre-tax ROCE of 18% to 20%.
18 to 20%. Now, how does that compare to where the company is now?
That's the crucial comparison. Their current overall enterprise ROCE is around 9%.
So they're aiming to basically double the return on the capital invested in these new assets compared to the company average today.
Exactly. That single comparison pretty much sums up the entire investment thesis, doesn't it?
It really does.
The current 9% return, that's sort of typical for a large established industrial company, maybe carrying some debt, operating in a tough market cycle.
Right.
But hitting 18–20% on the new investments, that doesn't just add scale. It fundamentally aims to double the efficiency of the capital they're deploying. It's a huge promise, a promise that these new assets are genuine game changers for profitability, not just for sheer production volume. #tagout outro.
So wrapping this up, this deep dive really shows a company in the middle of executing a massive internal expansion. They successfully commissioned the huge BF2 and BOF2.
Major milestones achieved.
And they absorbed that temporary but necessary financial hit that INR 250 crores that came with the planned shutdowns needed to make it happen.
The cost of change, like you said.
So the Q2 financials, when you look closely, they really tell the story of a strategic cost that was deliberately incurred to achieve a massive successful leap in capacity.
Yeah, I think the key takeaway for you, listening, is that strategic focus on discipline alongside ambition. They kept their debt, their leverage, firmly in check while spending billions. They defended their margins as best they could through high value-added sales in a weak market. They've successfully secured the physical assets, the hardware, if you like.
Right.
And now they're heavily adopting advanced technology, the software and intelligence to run it all efficiently.
So hardware secured, software being installed.
Exactly. And this raises, I think, an important question looking forward, something for you to think about. As they actually start managing this vast new capacity target, 15.6 MTPA, what kind of unexpected challenges or maybe even new opportunities might pop up from integrating predictive AI and machine learning so deeply into these very complex, very volatile, real-world industrial operations? It's one thing to build it, another to run it optimally with AI.
That's an excellent thought to leave us with. Moving beyond the physical build to the high-tech operational hurdles and maybe opportunities of next-generation industrial scale. We'll definitely be watching that interplay very closely.
Me too.
That concludes today's deep dive.